I saw a post today of some recency bias, which I feel like I haven't seen lately, but someone overlaying CPI annual change that we're seeing right now over what happened in the 1970s, where we got that secondary inflation spike. Is
Really?
that even really like a possibility?
A second inflation wave? Well,
It
I
just
think that
I think we're in a way different situation today than we were in
ye-
1970.
yeah, no, I agree with that. Like I think that I mean, we've been pretty vocal about this. Like the the issue that we have right now is we obviously are in a situation where the Fed is restrictive, right? And I think that that's what catches a lot of people like off guard. They don't really um they don't really think of it that way because you see the Fed at, let's just call it, two four and a quarter roughly, right? And the Fed hasn't gone down in terms of like the cycle lows haven't been lower in quite some time now, multiple months. So we've been pretty much sideways since the fall. And people see risk assets chugging around near highs. So they're like, okay, the Fed isn't restrictive. The Fed's not, the Fed's obviously not restrictive because asset prices would go down. And that's like not how we should look at the situation. And we don't really want to focus on where asset prices are going and the underlying position of the Fed. Meaning, just because if asset prices are up doesn't mean the Fed is loose or restrictive. What you have to look at it from a perspective like is this: the Fed is in a positive real interest rate environment where their Fed funds policy is above the rate of inflation. Okay, so the Fed funds rate right now is 4.33, something in that ballpark, and inflation is at 3. So the Fed is above the inflation rate. So they're in positive territory. Interest rates on the curve are in positive territory, right? So if you look out, they're in positive real yield territory, meaning the market's anticipating you getting a positive return on your investment after accounting for inflation in the future. So the market's pretty priced into a situation where it has a good understanding or grasp of where inflation is going, and it is accounting for it accordingly. Now, this is where things get interesting, and this is where we can like have a good conversation about the Fed's restrictiveness. And this has come to light lately, given the administrative changes in the government. But as we've been saying for months now, or a year now, or more than that, I think 2 years now, that the Fed has moved and is in a restrictive territory stance. The issue here is the administration at hand right now. So what you have going on is you have the government running deficits that we knew the prior administration were running large deficits as well, and we understand that we understood going into the elections that Trump would obviously have to run a deficit. There's no way he's going to run a surplus. You can't have a surplus in especially in America. Things haven't ended well when we had surpluses, right? So the government needs to run some sort of deficit to keep growth going. Just like for whatever reason you need to have um, Bitcoin, right? Let's take Bitcoin for example. It doesn't work good as a currency because it's deflationary. You need to have some inflationary force in the markets to keep spending and growth on its way. Long story short, we know Trump's coming in here. He needs to run a deficit. So he's going to have to obviously spend more than the government's making. And the issue here is that I think the market's a little unsure of the path of policy forward. It's not so much the Fed at this point. The Fed's restrictive. Now we're actually back to the fiscal point of view where the government has to reduce the deficit. Like if we take a look at the deficit, right? We can take a look at it as a percentage of I believe it's this one, as a percentage of, oh, nope, here we go. Sorry. We're spending 6.5% of GDP, basically, right? So as a percentage of GDP, the deficit is 6% of GDP. Now, in Trump's first term, we were looking at in the 3 to 4% range. So obviously the deficit's doubled since Trump, but it went down quite a bit due to COVID and since then we've retraced, but we're not so far back up to the pre-COVID environment. The reason this is important is the government's running a deficit right now, and we're looking at an administration that's trying to cut costs, which is great for the deficit. But the problem is they're making some comments, which I'm sure are just for PR purposes, like a PR stunt, but they're making some comments that make you wonder if they understand what exactly they need to do, because it's almost coming and seeming like what the government is claiming they're going to do is they're going to cut the deficit, right? And they're going to take the savings of cutting the deficit and distribute it out to the American people.
Yeah, like they were saying they're gonna distribute $5,000 from whatever they saved with Doge, $5,000 to everyone that's employed, which that would be pretty insane. I mean, we saw what happens when you get helicopter money like that after COVID. We saw Bitcoin rise, we saw meme coins rise, we saw the entire stock market rise. So, and that was less than $5,000. So, yeah, that would be pretty chaotic. I don't know if they're actually going to go through with that.
Right, but this is where it gets interesting, right? So obviously, again, I feel like it's a bit more of a PR stunt, but they're claiming that they're going to basically pay out savings that didn't really happen. Yes, the government, these Doge cuts are great, but what they're essentially doing is they're taking expenses away, or taking requirements away for future debt. It's not like the government's left over with the change and can distribute it. It's just the debt that the government didn't have to borrow is what's being cut. Unless something drastic happens where tariffs come in and cut the and bring up the revenues to cut the deficit, and in turn, income tax is also levied, right? Because right now we're talking sub 10%. We're talking about anywhere from 2 to 10% of incomes in the United States from tariffs. So revenues from the government does not come from tariffs. So if you think about this, something like $4 trillion comes from income taxes, right? So for you to replace that 4 to the 7 trillion, it's a significant amount of money. For you to say you're going to abolish the IRS and then come in with a alternative plan, you're going to need to have tariffs like, you know, up not just from 10 to 20%. You're going to need max tariffs to really cover that gap, which again, some of this sounds more like PR than actually executable in terms of the economic standpoint, which it's very clear. If you just look at it, the math doesn't add up. And the reason why we have to talk about this, and we don't want to go on a rant here about what would be perceived as nonsense on the surface, is because this is where things get interesting with the Fed, right? So the government's in a situation where the deficit right now is not something that we normally would see in an environment where the economy is running okay. The economy is not in a position that it's basically, the economy's hot, the economy's warm, right? It's I don't want to claim it's overheating, but it's not cold. It's not in
Warm as
contraction.
in growth is warm.
Yes, I'm saying like growth has been warm. Like if you look at the real GDP, right? Like we've been in the 3 to 4% real GDP consistently for quite some time. Like here, look at this, right? Let's look at real GDP quarter over quarter, right? Let's see if we can get this. Like look, right? So we are in like the 2 to 3% range. This is like, it looks normal, right? But it's this is a good economy. We're not at zero and we're not negative, right? So like on the surface, you look at this, you're like, oh, it's status quo. Well, like unfortunately for America, America's been in a status quo bull market or bullish economy most of the time, right? Like recessions are not frequent in America. So the economy is warm. I wouldn't say the economy is hot. Like I would say the economy would be hot if GDP was, real GDP was 5% plus, but the economy is warm. Now, the government's running this deficit as if there's a need to stimulate the economy. So what happens is the reason governments use deficits, right, is because they need to cover. So what ends up happening when you have a recession, when you have growth going from 3% or like in 2008, right, from plus 2% down to minus 8%, what happens is the economy slows, the government's revenues slow, right? the revenues of the government slow, but the expenses the government needs to maintain typically don't slow proportionally. They're left with larger, like think of Social Security. Like in a recession, is Social Security going to change? Is defense spending going to change? Is
Yeah.
healthcare's cost going to like right? So
So
they're
that's
left
when
with
you
less.
typically see those deficits.
Right. That's when they need to press the deficit because number one, they need to inject money into the economy and stimulate it. Right. It's not direct, but they need to basically put pressure on the economy to keep it to turn it around, and they need to account for the accounting differences due to a recession.
Well, isn't
The
that
problem
kind of
is
what our system is telling us right now as well? We've been seeing growth rolling over for the past few months now, and inflation still remains elevated. I think what we're seeing now in the stock market is the effects of this stagflationary environment where inflation's still elevated, not to the point where it's a problem to equities, but equities are highly correlated with inflation, right? As long as you have inflation, asset prices are going to rise. And I think that's why we've been getting this kind of chop and slow grind higher because growth isn't really pulling its weight, but we still have that positive inflation that is slowly dragging prices higher.
yes, that's a good point. So essentially, if we take a look at the economy from a perspective of output gaps, right, and we look at what is happening on a growth perspective from real GDP versus the estimated output gap or the estimated potential GDP, right? So what the economy should be doing at its maximized potential. And we look at where we are on a realized basis, you'll see we have a positive output gap, which means that there is a positive difference. The economy is currently running above expectations of its potential. It's basically running warm slash hot. How you want to clarify that? How do you want to classify this? Is up to you. So what's going on here is very simple. The economy is running in a situation like this. When you see a positive output gap building, what you want to do is you want to start cutting the deficit because the deficit is only going continuing a negative widening the deficit further is only going to exacerbate the issue more on the output gap, right? You're going to basically just keep putting pressure on the economy. And what this is a quick symbol of or a quick gauge of is the economy is not there's no real routes for this money to go, right? The deficit money. What's going to end up happening is it's putting this underlying inflation pressure in the market, which is why we're seeing inflation kind of baseline. Disinflation should continue, but the reason disinflation has been so slow is because we've been running such an aggressive output gap in the country, right? Now, this isn't really a problem up until recently. Now, for the last year and a half, we didn't really need to address this output gap because the idea was that the deficit would collapse under, it should collapse under Trump. The problem is like we're now in a position where we're talking about abolishing the IRS. We're talking about tariffing, which is not going to replace the income from the IRS, most likely. And we're also talking about these Doge cuts, which the Doge cuts help. But I think the market, the inflation, if we look at inflation from the way the market's looking at this, and this is why we have this global inflation swap monitor on our website. What you can see here is if you notice over the last 24 months, right, this spread was positive, meaning what this is telling you is it's telling you that inflation expectations on the longer run are greater than those on the shorter run, which is normal. When this spread goes negative, it says the market's getting a bit sensitive to inflation. Now you will see here we went from starting November, we went from a 8 basis point spread to a negative 10 basis point spread in the month of November. Now you might think, oh, that looks like a big jump here, big problem, but it's really not when you zoom out and you look at it like the whole 2022 environment. You see how we fell all the way down to like 130 basis points. So this little drop is not so significant. But what it's telling you is this, is like the market is obviously on edge about inflation. This is not to say that inflation is an issue, but the market is on edge regarding inflation more than it has been since 2023. Believe it or not. So since 2023, the market is more uncertain about inflation And therefore, I think that this situation that's going on in equities right now is that you're having an administration, right, that's faced with this situation. And I want to go back to the point that we spoke about at the beginning of the podcast, which might have gotten lost along the way. The Fed being restrictive. The Fed is restrictive because the Fed controls one component of the government's expenses, and that's their interest expenses. Now, the Fed actually has the power to raise or increase or decrease the interest expenses that the government has to pay on its debt. It takes time for it to roll through, right? Like we're still seeing the rising costs or the rising implications um, of, or I should say, we're still seeing the implications of raising interest rates so aggressively from a few years ago, bleeding into the government debt because it has to be refinanced at higher rates gradually over time. The Fed has that power. When you're running a 6% deficit and the expenditures of the revenue the government's receiving are up nearly double, right? For interest expenses. So they went from like 10% to 20% now, possibly looking to rise to 30%. The government has to make a decision that if they want to stop the deficit from rising, they can't just keep spending status quo. Because if they just keep spending status quo, the interest expense is going to continue to grow as more and more debt gets refinanced, right? So what the government has to do is they have to do something very simple. They have to cut the deficit. And what that's going to do is they're almost going to have to force some sort of negative pressure of liquidity into the economy if they want to fix that. Because the Fed's not going to just cut it. Think about it like this. If the Fed's going to cut interest rates, it's going to be because of a recession.
Yeah. But I mean, they even just recently came out and said that they're thinking of halting or slowing the balance sheet reduction. How does that come into play?
Well, that comes into play in a different sense, right? I think that the Fed is looking at it like from their perspective, reserves are not at a position where they're scarce, but they're no longer abundant. They're kind of in the middle and slowly falling down. And we'd have to see what really happens. Do they halt the balance sheet, or do they cut it again, right? Or do they just completely stop the runoff? I don't know. We're gonna have to see. But that is something else, I think, in terms of like I don't think that really has much play with the deficit, right? Like I think the issue here that the market's afraid of is the market's almost priced, right? The market's priced for the deficit to continue. The reason the market's at all-time highs right now and multiples are so wide is because the deficit that we run at 6%.
Yeah. So
But
it
like
is that inflationary pressure that's pushing it higher.
that's pushing asset prices up. Yeah, and it's also what's preventing inflation for itself from getting back down to target. Like government expenditure is preventing the 2% target. Like for example, if the government were to correct the deficit from 6 to 3%, inflation would likely, it's not a tit for tat move, but inflation would be much closer to target,
Yeah. So we pretty much have the
right?
government fighting the Fed in their objective.
Yes, and this is where the Fed has control because the Fed, they have the ability to sit back and say, you know what? We're not going to cut interest rates. We're going to just hold. And that alone is putting additional pressure over time on the government. And this is where, like, in my opinion, I think what we need to do is we need to the cut the waste and nonsense. I agree. There's a lot of waste and nonsense, right? We need to cut that. We need to put tariffs on, but we also, to some degree, can't be cutting income taxes so aggressively. Like abolishing the IRS is not going to happen. I don't think. Right? Because like you're going to end up in a situation where your deficit's even greater.
Yeah.
And what
And
ends up
once you
happening when
abolish the IRS, it's not very easy to bring it back. I think
oh
once
no.
people get a taste of no income tax, they're not going to want to go back.
Yeah, and like I'm not saying that income tax itself is like having income tax is a requirement, but when you have the government subsidizing a lot of these social programs, right? that's the cost, is the income tax. Now, you can claim that, we don't, is Social Security a Ponzi scheme? Absolutely. But we're still going to pay for it unless we're not, right? If we're not going to pay for it anymore, then yeah, you drop Social Security, you drop the healthcare spending, you drop like a good part of defense. Yeah, you don't need that much in taxes. The tariffs might actually work, but we're not going to do that. That's the problem, right? So that's the issue here, and that's a very catch-22 dilemma. But ultimately, I think that when we take this back into perspectives of what's going on in the market, the Fed is in a position where they're tight, but they also they can go tighter. But I think that they understand that there's a gap here between fiscal and what they're doing, and like if they let the government run, if they run too hot, what's going to happen is the Fed doesn't also want to create a recession here either, because theoretically it's hard to say that the Fed could create a real recession right now with the deficit where it is, and the deficit will only get worse. So from a stability standpoint, a recession starting at a 6% deficit is ridiculous. You're
Yeah.
talking about extreme stagflation at that point, right?
Yeah.
Because spending's only going to get worse. And you could, some people will even claim it's impossible to have a recession when you have a deficit at 6%. Now, I do think that Trump and his administration is deficit friendly, but I think that at least he was the first term. The way that it's coming off this term is a little bit, it's a bit late, as of late at least, it's been a little bit confusing. He's talking about 8% DoD cuts, which are good. This is good to cut waste wherever you can, and DoD is a big sector of the expense ratio of the government. So yes, these are all good cuts. But abolishing the IRS and all this stuff, like I don't know if that I don't see the feasibility or the plan, the execution plan there, and not harming the deficit,
Yeah. I think it's got
It's
to be kind of fine tuned, maybe not fully cut the income tax, but depending on how much they're able to save in other areas, they might be able to lower it a little bit. I don't know if that's something that they're planning on doing or if they want to actually fully abolish the IRS. I don't know. But
I don't know either. I mean, that's just the comments that I've been hearing in the headlines. So, I do also understand, like, listen, this is not to be taken politically. Like, I understand some comments are made by associates of the president and not the president himself. Like, sometimes we read headlines, so they're, maybe from this chairman or that chairman, and you're like, oh, great, like this is what Trump wants to do. But in reality, Trump, like, for example, Trump never said $5,000 checks, right? That was never said by him. He himself never said that. So it's we're talking about the Doge cuts. So you got to always take this with a grain of salt. But I do think that where we are right now, it's a very peculiar spot where, like, the the deficit is supportive for inflation, but it's quite obvious that the rate of inflation or the rate of disinflation that we've been seeing has been outweighing those deficit style effects. The question is, do we get to 2% with the government running a 6% deficit? I think that it's possible. Disinflation is not over yet, but I think that you're seeing this now. Like, the Fed had a lot of power up until about, if we put the Fed funds rate on here, let's see. You'll see right here, the Fed had a lot of power here on inflation up until about, I'd say, like July of 23. Inflation started slowing, but the Fed didn't cut interest rates. You see that? Like,
yeah,
the
they
head Fed just
they
held,
played it
and
well. They played it well,
the
and
F- the Fed, yeah,
I think
they
they
did.
need to stay fairly tight still, especially with this deficit that's happening. But I think that opens up some downward inflation risk as well. Like I think the market is pricing in that inflation right now. That's what we're seeing. That's why the Nasdaq and the S&P has been making new highs, because it's not growth that's doing it at the moment. Growth is, I mean, growth is good. Growth is warm, like you said, but the market has started to price in a growth slowdown over the last few months. So I think a
Yeah,
lot of
that's
what we're
true. That's
seeing
true.
now is actually inflationary pressures. And once the rug gets pulled out, if those inflationary pressures all of a sudden get pulled out and growth still isn't making a rebound, growth expectations, and our system is still telling us that growth is on the way down, I think there could be a rug pull that happens on equities.
It's possible. Now, like, let's just talk about this for a second, right? We're running a 6% deficit, right? Unfortunately, this is old news too. This is not like breaking news, but we're running a 6% deficit. This has been going on for quite some time now. And the market, right? You look at it from a market's perspective, the market's doing, it's almost as if like that deficit, like that deficit here, like what, if you look at the deficit like this, right? Like, let's just really look at this. So what you have happen here is very interesting. Let's go to a weekly chart. Okay. So here is the deficit, right? So the market goes, the COVID hits, right? And this is all delayed. This is all delayed, right? Because like COVID hits and the market drops, but like this is an entire year delayed. So understand that the deficit line is lagging. So you have this COVID hit. The government goes and runs a negative 15% deficit in 2020. They need to stimulate the economy, right? So the market falls here, 2020. Government needs to stimulate the economy. Negative 15% deficit. Not only do they fill the loss in growth, they overshoot it. The market runs on a glory run here, a liquidity run of this literally of the century. Okay, vertical mode. And what ends up happening is the deficit value snaps back from negative 14, right, to negative 12, negative 11, and then from negative 11 all the way up to negative 6. And this also so happens that the market starts going down, right? So you took some of this deficit away from the market. The market's taking a bit of a shock, right? Still up quite a bit, but it's cooling down here, and the deficit's still running. And the market realizes that like this deficit isn't going to change, and we're not going into a recession either. In 2022, we couldn't get into a real economic recession. The market priced in a recession. Inflation was high. Deficit was still pretty, is -6%, -5%, something like that. Market's like, okay, like we're looking at real stagflation risks here, right? We have inflation running hot. The government's running hot. The Fed isn't paying attention. Real inflation risks. The market gets smacked. Deficit's still there. Market goes up. Deficit's still here now, right? Market's at all-time highs. Inflation's down. And what you're looking at right now, it's very simple. The market is almost seemingly at a juncture where any increase in the deficit is going to create a stagflationary effect because inflation is where it is. Like if you let the deficit fall, you're going to just increase inflationary effects in the market. And in turn, growth, because you have to understand growth is not negative right now. It is slowing, but it is not negative. So if any move down in the deficit in an environment where growth is still plus 2% real on GDP, you're going to end up in a situation where you stagnate on growth and it drifts lower and inflation rolls higher. And that's stagflation, right? And eventually growth falls down and it becomes worse and worse and worse. And the only way to really fix this cycle is to wash it out with a recession, unfortunately. But obviously, anyone that's been listening to us for long enough knows that the base case cannot be a recession. The equity markets are resilient, right? So, like, they are going to always, if there's inflation and the growth isn't too bad, they are going to price out that inflation. They're going to rise. You're going to rise. You're going to offset those inflationary pressures. I think that we have to look at this as a possible macro risk here with the current administration, where we're obviously seeing the growth slow down already. So any type of additional pressure to the growth slowdown, i.e., aggressive deficit cuts or a rebound in inflation where the Fed has to talk about lifting policy rates, even though that's much more unlikely. Those have to be something that we think about, but it's not the base case, right? So the base case is going to be that if you're looking at equity markets as a whole, you simply just take the trend, take the regime. We obviously know that we're in a growth slowdown, right? Um, and we obviously know that equity markets are in fact bullish trends still. So there's a two-step process here. If equity markets can stay a bullish trend, the imminent risk, you don't think about a recession when the equity markets are in bullish trend. As long as QQQ is above 500, we could ponder the idea of a deficit a reduction of deficit induced recession, but we can't actually anchor on it. It's not here just yet, right? As long as the Qs are above 500, which is Momo, we sit back and say, you know what? That's a possible risk on the horizon. But right now, equities can chop sideways and give us more of that traditional stagflation / slowdown environment. But a recession is not coming without the Qs going below 500. Other than that, thank you guys so much for listening. We'll catch you guys next week on the next episode. If you enjoyed the podcast, please like and share with your friends. If you want to see more of our products, go to www.market-radar.com.